London gold surges while crude oil languishes. An abnormal disconnect triggered by the Maduro incident. London gold has skyrocketed while crude oil remains mired in a slump, forming an abnormal market disconnect, with the Maduro incident serving as the trigger. Behind this lies institutional manipulation leveraging geopolitical sentiment, compounded by selling pressure from index rebalancing and the test of non-farm payroll data. Short-term correction risks have emerged, but amid global central bank gold purchases and the de-dollarization wave, the long-term trend of gold's value restoration is clear, and the restructuring of the global monetary system is already on the horizon. When news that London gold had surged over 1.69% in a single day to breach the $4,400 per ounce mark swept through the financial sector, an anomalous phenomenon left veteran market observers pondering. WTI crude oil, also a safe haven asset, not only failed to climb in tandem but also oscillated at the low of $57 per barrel, even opening lower intraday. On one side, fervent buying in the gold market. On the other, calm apathy in the crude oil market. Behind this disconnect lies covert geopolitical manipulation, or a precursor to the restructuring of the global monetary system. The global financial markets in January 2026 are being roiled by a chain reaction, sparked by the situation in Venezuela, and the undercurrents beneath the surface are far more turbulent than what meets the eye. The immediate trigger for this market volatility was the military operation codenamed Absolute Resolve, launched by the U.S. military in the early hours of January 3rd according to details disclosed by General Kane, chairman of the U.S. Joint Chiefs of Staff. U.S. President Donald Trump issued the raid order at 22:46 Eastern Time on the 2nd, with more than 150 aircraft participating. President Nicolas Maduro and his wife were brought aboard a U.S. military warship at 3:29 Eastern Time on the 3rd, and subsequently extradited to New York, USA. The U.S. stated publicly that the operation was based on allegations that the Maduros had committed deadly narco-terrorist acts against the United States and would face trial in U.S. courts. A video released by the White House social media account that night showed Maduro wearing a dark hoodie and slippers and in handcuffs, walking down a corridor under the custody of several U.S. Drug Enforcement Administration D agents. Responding only briefly with good night and Happy New Year, his first public remarks since his arrest. The forced capture and extradition of a sovereign head of state by another country for trial is extremely rare in the history of international relations, instantly sending global geopolitical risk soaring. Venezuela's Supreme Court responded swiftly, ordering Vice President and Oil Minister Delcy Rodriguez to serve as acting president on the 3rd to ensure administrative continuity and the country's comprehensive defense. It explicitly stated that Maduro had been kidnapped and emphasized the need to safeguard national interests amid the current foreign aggression. Brazil's Ministry of Foreign Affairs immediately stated its recognition of Rodriguez as Venezuela's legitimate leader and reaffirmed its support for international law and the defense of national sovereignty. Russia's Ministry of Foreign Affairs denied false reports that Rodriguez is in Russia, adding more complex variables to the Venezuelan situation. The market's initial reaction was entirely in line with expectations of escalating geopolitical conflicts. Most analytical institutions sounded the alarm immediately, defining the incident as a signal of escalating war risks, and issuing intensive recommendations for safe haven gold allocations. From a common-sense perspective, this judgment was not unfounded. Venezuela holds the world's largest proven oil reserves, and the turmoil in its risk. But as a U.S.-led restructuring of the energy landscape, the core U.S. objective in this operation may not be mere judicial accountability, but rather targeting Venezuela's abundant oil resources. The market widely speculates that the U.S. move is intended to clear the way for energy giants such as Chevron and ExxonMobil to enter Venezuela's oil industry in the evaluation system of Wall Street capital. Venezuela, long sanctioned and plagued by frequent debt defaults, has long been defined as a distressed asset portfolio, and direct military intervention may serve as a shortcut for the U.S. to push for the restart of its oil production capacity. This speculation is not groundless. Data shows that Venezuela's oil production capacity once exceeded 2 million barrels per day BPD before sanctions, but currently hovers around 700,000 BPD if the US takes the lead in promoting Chevron and other enterprises to take over operations. Coupled with Western technical and financial support, Venezuela's oil production capacity is expected to recover to over 1.5 million BPD within 1 to 2 years. For the global energy market, this means an additional 800,000 BPD of crude oil supply, equivalent to 0.8% of total global crude oil demand. Against the backdrop of a basically balanced global crude oil supply and demand, expectations of increased supply are sufficient to suppress oil price gains, which is the core reason for the prolonged slump in WTI crude oil prices. The market's real expectation is not a supply shortage, but a sustained influx of cheap crude oil, and behind this expectation lies the US's in-depth strategic consideration of using Venezuela's oil resources to curb global inflation and hit Russia's energy exports. Having clarified the logic behind the crude oil market's calm, the gold market's frenzy becomes even more intriguing. Trading data from the London Bullion Market Association (LBMA) provides a key clue. During the core period of the gold price surge, multiple large gold buy orders of tonnage scale emerged during the Asian trading session, each with a transaction volume of over 10 tons, far exceeding the capacity of retail capital. The industry generally judges that these large buy orders are behind the asset allocation adjustments of global central banks, converting assets backed by the credit of the US dollar into physical gold in tangible form. Behind this asset shift is a deep-seated concern among central banks about sovereign asset security. The US's arbitrary arrest of a sovereign head of state has broken the last line of defense of the US dollar credit system, sending a clear signal to the world. The safety of US dollar assets is no longer absolutely guaranteed. Gold reserves held at the Federal Reserve Bank of New York may be seized, and US Treasury bonds held face the risk of being arbitrarily written off. This reassessment of sovereign risk, which transcends war risks, is spreading across the global central banking system. Data from the World Gold Council (WGC) shows that the share of global central bank gold reserves rose to 20% in 2025, surpassing the euro to become the second largest reserve asset after the US dollar, a trend that continued to accelerate in early 2026. Specifically, central bank gold purchases across the globe exhibit distinct structural characteristics. Poland's central bank was the largest official buyer in 2025, purchasing a total of 67 tons in the first 3 quarters and raising its target gold reserve ratio from 20% to 30%. Kazakhstan's central bank bought approximately 40 tons in the first 3 quarters. China's central bank increased its gold holdings for 13 consecutive months, purchasing a total of 24 tons in the first 3 quarters, continuing to advance the diversification of reserve assets. Emerging market countries such as Turkey and Brazil also made significant gold purchases. These gold buying actions are not short-term speculation, but strategic allocations based on the de-dollarization trend, aimed at hedging the safety risks of reserve assets brought about by US dollar hegemony through gold, a credit risk-free asset. Notably, global central bank gold demand has resonated with private investment demand. Data from the China Gold Association shows that China's gold consumption reached 682.73 tons in the first 3 quarters of 2025, of which gold bar and coin consumption stood at 350.116 tons, exceeding jewelry consumption of 270.036 tons, with investment demand accounting for more than 50% for the first time. Trading data from the Shanghai Gold Exchange (SGE) reveals that the current domestic gold price in China has a significant premium over the international gold price, with the premium maintaining at $15-20 per ounce. In the Indian market, gold dealers also generally sell gold bars at a premium, with some brands even commanding a premium of up to $30 per ounce. This premium phenomenon indicates that the world's core physical gold buyers have extremely low price sensitivity and prioritize the ability to obtain spot gold, with gold having transformed from a mere investment product into a ballast for asset security. However, just as global central banks and private capital are jointly pushing up gold prices, a hidden selling bomb is approaching the annual rebalancing cycle of the Bloomberg Commodity Index BCOM. As a key benchmark index for the global commodities market, BCOM currently tracks approximately $108.8 billion in capital, and its adjustments directly trigger algorithmic position rebalancing by passive funds. According to the latest adjustment plan announced by Bloomberg, the overall target weight ratio for precious metals will be adjusted to 18.84%, with gold's target weight raised from 14.29% to 14.90% and silver's target weight lowered from 4.49% to 3.94%. Affected by the sharp rise in gold and silver prices in 2025, their actual weights in the BCOM index have far exceeded the target allocations. Data provided by Zhang Chen, a precious metals analyst at DI Futures, shows that before this adjustment, gold's actual weight had risen to 20.7% and silver's actual weight reached 8.3%, both significantly deviating from the target allocations. This means that passive funds tracking the index must sell gold and silver futures during the adjustment period from January 8th to 14th to bring their positions back in line with the target allocations. Jiu Fengda, chief analyst at Gosen Futures, estimates that the scale of gold futures selling involved in this adjustment is approximately $4.55 billion, and silver futures selling is about $3.4 billion. Among them, the silver market may face a more obvious short-term impact due to weaker liquidity. This technical adjustment forms a stark counterweight to the core driving logic of the current gold market. Wall Street market makers have clearly anticipated this trend, and the emergence of the Maduro incident has provided them with a perfect operational opportunity. Against the backdrop of clear expectations of forced selling by passive funds, if gold prices remain around $4,300 per ounce, the massive sell orders from passive funds could directly break through the key support level of $4,000 per ounce, leading to a market crash. Therefore, institutions such as Goldman Sachs and JP Morgan Chase have taken advantage of the panic sentiment triggered by the Maduro incident to actively push up gold prices, creating the market illusion that gold prices will break through $5,000 per ounce. The goal is to lure retail investors to take over at highs above $4,400 per ounce and complete the transfer of chips. This building a false front to conceal real intentions operational logic is not unprecedented in history. During the gold rally triggered by the 2023 Silicon Valley Bank collapse, institutions similarly pushed up gold prices by capitalizing on market panic, then unloaded their positions during the passive fund rebalancing cycle, leading to a short-term correction of over $200 per ounce in gold prices. Comparing the current market environment, a similar script is playing out. A geopolitical incident triggers panic buying by retail investors. Institutions take the opportunity to unload at highs. Technical adjustments trigger short-term corrections, and the market ultimately returns to its long-term core logic. To make matters worse, the gold market will face another crucial test this week, the first non-farm payroll data of 2026. The U.S. Department of Labor will release the December non-farm payroll data this Friday, with the market currently expecting approximately 50,000 new jobs added. This data will directly impact market expectations for Federal Reserve monetary policy, which in turn will be transmitted to gold prices. If the data significantly exceeds expectations, it will strengthen expectations that the Federal Reserve will maintain a hawkish stance, driving a rebound in the US dollar index and exerting downward pressure on gold prices. If the data falls significantly short of expectations, it may trigger market concerns about U.S. economic recession, providing short-term support for gold prices. More critically, the non-farm payroll data coincides with the BCOM index adjustment in terms of timing. If the selling wave triggered by the BCOM index adjustment on Thursday has not subsided, and the non-farm payroll data on Friday unexpectedly shows strong performance, gold prices will face a double blow of technical selling pressure plus macro bearish factors, and a cliff-like drop is highly likely. Industry estimates suggest that in an extreme scenario, Gold prices could fall from $4,400 per ounce to below $4,250 per ounce in the short term, a drop of over $150 per ounce. However, most institutions believe that this correction is not the end of the trend, but a phased adjustment in the course of a long-term rise. SDIC Futures pointed out in its latest research report that the passive selling brought about by the BCOM index adjustment is a spray in the course of a trend, which may cause short-term fluctuations but is unable to reverse the tide determined by more fundamental forces. The core logic supporting the gold market at present sustained gold purchases by global central banks, weakening US dollar credit, and the normalization of geopolitical risks remain unchanged. And these factors have laid a solid foundation for the current precious metals rally. Fengda advised investors to focus on the big picture and ignore minor fluctuations, urging them to concentrate on the fundamental logics that determine the long-term direction of the market and to take advantage of the current price pressure to buy the dip and appropriately increase their positions. From a long-term perspective, the current rise in gold prices is not a simple market fluctuation, but a value restoration against the backdrop of changes in the global monetary system. The core driver of this transformation is the deepening of the de-dollarization wave, and the occurrence of the Maduro incident has undoubtedly added fuel to this wave. Data shows that the share of the US dollar in global foreign exchange reserves fell below 58% in 2025, hitting the lowest level since 1995. The proportion of local currency settlement within the BRICS countries has exceeded 30%. Oil trade between Russia and India and bulk commodity trade between China and Brazil also widely bypasses the US dollar. The non-US dollar settlement system being advanced by the BRICS countries has become the core engine of de-dollarization. In July 2025, Russia announced plans to establish a financial center independent of the US dollar system. The platform's technical implementation is led by the finance ministries and central banks of various countries, with a pilot launch planned for 2026. According to Elvira Nabiullina, governor of the Central Bank of Russia, 159 countries have expressed their readiness to adopt the BRICS payment system, a number far exceeding the existing BRICS member states. In terms of economic volume, the GDP of the BRICS group reached $63.2 trillion in purchasing power parity PPP terms, surpassing the G7's $52.3 trillion. In the energy sector, BRICS countries account for 43.1% of global oil production and 44% of reserves, as well as 35.5% of global natural gas production and 53% of reserves, laying a solid foundation for the construction of an independent energy trade settlement system. Notably, the BRICS countries' ongoing plan for a supranational currency, the unit currency project, although it did not officially launch as scheduled on January 1, 2026, and faces multiple challenges including coordination differences among member states, technical bottlenecks, and logistics costs, with a low probability of official launch before 2030. Its design concept provides a new direction for the reform of the global monetary system. According to the original conception, the unit currency will be backed by 40% physical gold and 60% BRICS currencies, forming an essential distinction from virtual currencies such as Bitcoin that lack physical backing. This gold-anchored currency design can effectively hedge exchange rate fluctuation risks and address the asset security risks under the US dollar settlement system. In the current global trade pattern, the drawbacks of US dollar settlement have become increasingly prominent. Traditional energy trade, such as Saudi Arabia's oil exports to China and Russia's natural gas exports to Europe, has long relied on US dollar settlement, and these US dollar assets may be frozen at any time due to US sanctions policies. Countries such as Russia and Venezuela have all experienced the seizure of US dollar assets, making more and more countries realize that over-reliance on US dollar settlement poses fatal risks. If the unit currency can be popularized in bulk commodity trade in the future, countries will be able to conduct cross-border settlements through gold-anchored currencies, and gold will transform from a traditional passive safe haven asset into a necessary active tool for trade settlement. With its demand scale set to see a quantitative increase, To ensure the safe operation of the non-US dollar settlement system, the BRICS countries are strengthening defense cooperation from January 9th to 16th, 2026. The BRICS joint military exercise codenamed Will for Peace 2026, led by China and hosted by South Africa, will be officially held, with warships from Russia, Iran, and other countries all in place. This marks the first time the BRICS countries have brought military coordination to the fore, transforming the organization from a mere economic and trade cooperation group into a strategic cluster with both economic and defense coordination capabilities. Against the backdrop of severe challenges to global trade security, the protection of military power will provide a solid guarantee for the advancement of the BRICS non-US dollar settlement system and further accelerate the de-dollarization process. Changes in the global economic pattern have provided broader space for de-dollarization. Data shows that the 11 member states of the expanded BRICS account for 45% of the global population. Their GDP in PPP terms has exceeded 37%. And is expected to grow by 3.7% in 2026, far exceeding the G7's average growth rate of less than 2%. The total GDP of BRICS countries is expected to exceed $50 trillion in 2026, surpassing the G7's $40 trillion. Driven by economic growth, intra-BRICS trade volume has continued to climb, growing against the trend by 15% in 2025. And the internal circulation system has been continuously strengthened. This improvement in economic strength provides a solid economic foundation for the promotion of the non-US dollar settlement system and also further highlights gold's position in the global monetary system. Returning to the gold market itself, institutions are generally optimistic about its 2020. The World Gold Council predicts that gold prices are expected to rise by another 15% to 30% in 2026. Breaking through the $5,000 per ounce mark. JP Morgan Chase stated that the structural trend of central bank gold purchases will continue in 2026, with global central bank gold purchases expected to reach approximately 755 tons for the full year, lower than the peak of the previous 3 years, but still significantly higher than the long-term average of about 400 to 500 tons before 2022. At the same time, gold ETFs are expected to see a net inflow of approximately 250 tons in 2026, and annual demand for gold bars and coins will exceed 1,200 tons once again. If only 0.5% of overseas U.S. asset allocations shift to gold, the additional demand will be sufficient to push gold prices up to $6,000 per ounce. UBS offered a relatively cautious forecast, arguing that current gold prices are already at a high level, and if the Federal Reserve unexpectedly shifts to a hawkish stance or large-scale redemptions occur in ETFs, gold prices may face downward pressure. Historical experience shows that gold prices may enter a consolidation period after the U.S. election, and are expected to edge down to $4,800 per ounce by the end of 2026. However, if political or financial risks rise further, gold prices are expected to surge to $5,400 per ounce. Wu Zuwei, a special researcher at Jiangsu Commercial Bank, emphasized that the core logic supporting the long-term gold bull market remains solid, and global central bank gold demand is expected to continue in 2026, providing underlying support for gold prices. At the same time, the market generally expects the Federal Reserve to cut interest rates twice by 25 basis points each in 2026. And the decline in nominal interest rates driving lower real interest rates will further boost gold's attractiveness. Overall, the gold market will face the dual test of BCOM index adjustment and non-farm payroll data this week, with significant short-term correction risks. But this does not change the core logic of gold's long-term rise. For investors, the key in the current market is to distinguish between short-term noise and long-term trends. The panic sentiment triggered by the Maduro incident and the passive selling brought about by the BCOM index adjustment are all short-term disturbance factors, while sustained gold purchases by global central banks, the deepening of de-dollarization, and the restructuring of the BRICS monetary system are the core drivers supporting the long-term rise in gold prices. From an operational perspective, rational investors should avoid being swept up by short-term market sentiment and refrain from blindly chasing gains at highs above $4,400 per ounce. Focus should be placed on the key support range of $4,250–$4,300 per ounce. If gold prices fall to this range due to passive selling, it can be regarded as a good opportunity for medium and long-term layout. This range is not only an important technical support level but also a desirable price range for global central bank gold purchases. And central banks such as China and India are highly likely to increase their gold holdings on these occasions, forming strong demand support. It is important to be vigilant that current gold prices are already at an absolute historical high, and the pricing of some positive factors may be relatively sufficient. Market trends will closely follow the Federal Reserve's policy moves and U.S. economic data, and volatility is expected to increase significantly. However, as gold is in a historic bull market, technical corrections triggered by profit-taking or policy expectation revisions should be regarded as opportunities for long-term layout rather than the end of the trend. For ordinary investors, excessive attention to short-term price fluctuations is not advisable. Instead, focus should be placed on gold's role as a safety cushion in asset allocation and participation through long-term dollar-cost averaging and diversified allocation to avoid risks brought about by short-term market volatility. Looking back at the U.S.'s arbitrary arrest of a sovereign head of state is accelerating global doubts about U.S. dollar credit. The non-U.S. dollar settlement system and supranational currency plan being advanced by the BRICS countries are providing new possibilities for the global monetary system. And the continuous increase in gold holdings by global central banks is reshaping the pattern of global reserve assets. In this historic transformation, gold, as the ultimate credit risk-free asset, will continue to highlight its monetary attributes and become a core tool for hedging global uncertainties. In the future, with the deepening of de-dollarization, the strengthening of BRICS cooperation, and the normalization of global geopolitical risks, the logic for the gold market's rise will become even more solid. Short-term market fluctuations will eventually pass, and gold's position in the global monetary system will be redefined in this transformation. For investors, recognizing this historical trend and abandoning short-term speculative thinking is the key to seizing long-term opportunities and achieving asset preservation and appreciation in a complex market environment. The gold market is simmering with undercurrents in January. The chain reaction triggered by the Maduro incident has not subsided, and the tests of BCOM index adjustment and non-farm payroll data are already approaching. This market volatility is not only a test of investors' judgment but also a microcosm of the restructuring of the global monetary system. In this historic transformation, gold is moving from the background to the foreground, re-emerging as the core anchor of the global financial market, and this trend may have only just begun.